all your friends are investing in meme stocks, it's okay to pause and ask yourself, what would Warren Buffett do? Which is why in this video, we are going to share the top advice from investing experts on the 7 biggest investing mistakes to avoid at all costs. Starting with mistake number 1, FOMO, or fear of missing out. American economist Paul Samuelson famously said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. By likening investing to watching paint dry or grass grow, Samuelson wanted to convey the idea that successful investing is not about seeking immediate thrills or quick gains. Just as paint dries slowly or grass grows gradually, the real value in investing comes from allowing your investments to grow steadily over time. I know this sounds boring, but here's the thing. We've all heard the stories of people investing in something early and making a fortune, which is why FOMO can be tempting. When everyone around you seems to be talking about a hot new investment opportunity, it's natural to feel like you should jump on the bandwagon too. But take a moment to stop, sip some tea, do the necessary research first, and ponder whether the investment truly fits your financial journey. Weigh the risks on one side and the pros on another side, and then make a calculated, emotionless decision. Remember, not every opportunity is suitable for you, and what works for others may not work for your unique situation. Investing is a journey, not a race, so avoid making impulsive decisions driven by fear or excitement. Instead, stay disciplined, trust your research, and invest in assets that have solid fundamentals and align with your long-term objectives. And then, if you really still do want to invest in something that's high risk with high returns, make sure it's only a small percentage of your overall investment portfolio if you'd like to still play it safe. Mistake number 2 is timing the market. In the words of Philip Fisher, the stock market is filled with individuals who know the price of everything but the value of nothing. Timing the market involves predicting the highs and lows of the stock market and making buy or sell decisions based on these predictions. The truth is, even financial experts struggle to consistently time the market correctly. It's a bit like predicting the weather in England. One moment it's sunny and a few minutes later it's raining. And the financial markets, my friends, are no different. Instead of trying to time the market, focus on time in the market. History has shown that a long-term investment approach has been more successful than attempting to make short-term predictions. Successful investors don't waste time trying to predict market movements. They stay committed to their investment plan and resist the urge to react emotionally to market fluctuations. So stand firm, committed to your investment strategy, and unmoved by the market's unpredictable shenanigans. By avoiding market timing traps, you can position yourself for long-term success. Mistake number 3 is overconfidence. Warren Buffett once said, "I don't look to jump over 7-foot bars, I look around for 1-foot bars that I can step over." The lesson for us meager peasants still trying to make it in life? Seek out simple, achievable goals in investing and I guess life in general. The strategy is to aim for consistent, smaller gains that compound over time rather than risky, high-reward plays that may not succeed. Feeling invincible can lead investors to take on excessive risk without fully understanding the potential consequences. Overconfidence can be a result of past successes or simply underestimating the complexities in the financial markets. Investors who believe they can't make mistakes may engage in risky behaviors without proper research or analysis. But in the markets, my friends, the only certainty is that there is no certainty. So how to dodge this trap of overconfidence, you ask? Stay humble and continuously educate yourself. Remember, the best investors are those who recognize their limitations and continuously seek to improve their knowledge and decision making. Mistake number 4 is ignoring diversification. Peter Lynch's quote, "Know what you own and why you own it," is a fitting reminder as we discuss the importance of diversification. Ignoring diversification is a mistake that cannot be emphasized enough. Concentrating all your investments in a single asset or a sector is like putting all your eggs in one basket. Diversification is one of the cornerstones of a well-balanced portfolio. So how do you do this? Well, by spreading your investments across different asset classes and industries. By doing this, you reduce the impact of potential losses in any single investment. Don't limit yourself to just stocks from one sector or even from one country. Explore various investment options such as bonds, real estate, commodities, and international markets. Diversification helps mitigate risk and enhances the potential for stable long-term returns. Having a well-diversified portfolio doesn't mean you avoid all losses, but it does help protect you from the potential devastation of a single investment that goes bad. Remember, the goal is to have a balanced portfolio that aligns with your own risk tolerance and financial goals. Mistake number 5 is emotional trading. Making investment decisions based on fear, anxiety, or excitement can lead to disastrous outcomes. So keep your chin up and your decisions level-headed. Emotional trading occurs when investors let their feelings drive their investment decisions rather than relying on rational analysis. Fear can lead to panic selling during market downturns, while excitement can cause impulsive buying during market peaks. Such behavior can severely impact your overall investment performance. So, to overcome emotional trading, stay disciplined and adhere to your investment plan. Develop a strategy that aligns with your financial goals and risk tolerance. And of course, regularly review your investments, but don't let daily market fluctuations influence your long-term decisions. Mistake number 6 is chasing hot tips. John Bogle's quote, "Don't look for the needle in the haystack, just buy the haystack," serves as a powerful reminder as we discuss another major investing mistake: chasing hot tips and following investment fads without proper research. You see, in the age of social media, online forums like Reddit, and even YouTube, it's easy to get bombarded with investment recommendations from various sources. And there's nothing necessarily wrong in that. Sometimes these tips can be good. However, blindly acting on these tips can lead to a disastrous outcome, which is why it's essential you always do your own research no matter what you hear or see online. Remember, not all tips are based on reliable information or the long-term potential of an investment. So it goes without saying, be cautious of get-rich-quick schemes and promises of extraordinary returns, unless, of course, you understand that they come with extremely high risk as well. So take the time to research and analyze potential investments. Don't jump headfirst into something without doing your research first. Seek advice from trusted financial professionals if needed, and always make decisions based on sound financial principles rather than impulsive recommendations. And finally, mistake number 7, failing to adjust your investment strategy. Failing to adjust your investment strategy when necessary can be a costly mistake. Times change, and so must our investment approach if needed. The financial markets are dynamic and economic conditions can change over time. So your investment plan should evolve with your changing lives. For example, as you move through different life stages or experience significant life events such as marriage, having children, or nearing retirement, your financial goals and your risk tolerance may shift. Therefore, it's crucial to regularly review your investment portfolio and make adjustments to keep it in line with your objectives. Additionally, periodic rebalancing of your portfolio is essential. Over time, certain assets may outperform or underperform others, causing your original asset allocation to deviate. So there you have it, the 7 biggest investing mistakes to avoid.